Hello guys, welcome to our YouTube channel. Today I'm going to teach you how I avoid losing trades. For those of you who are new to the channel, you have to watch the first video so that you can understand what I'm going to teach you. I have two models that I trade. The first one is this one, the one that I use, the Fibonacci, and then the 50%. You can see every time price moves to the 50% level, price goes to the upside. Every time the price touches the 50% level or close to it, it goes to the upside. And the reason why I put my Fibonacci to the bodies of the candles is that's one of the rules that I use. I don't change it. No matter what happens, I don't change it. I don't tweak it. I don't try to, one day put to the wick, one day put to the body. I always put to the body, and this is one of the methods that I use to trade the markets. So guys, today I will show you another method that I use, that I was using last week, and I avoided a lot of losing trades by just using that one. We are using Euro USD, the daily chart, so that you can understand that you can stick to one bear and then make money from that one bear. So guys, I have two models that I use. So one of the models, the one with the Fibonacci, it only works for me when I'm expecting the green candles, when I'm expecting the continuation of the trend. But the days that the bullback is happening, you all know that I'm using the daily time frame. So these days that the bullback is happening, it means you don't have to take trades. But then I utilize these days themselves by using another strategy. If price does not follow this strategy, then I'm not going to trade even the bullbacks. So today we'll show you that one. The reason why I mark them these days, the reason why I put these lines and separate them is to show you something. In order to backtest this strategy, you have to divide the days because it involves with time. We are going to learn time and price together. You see, these factors move hand in hand. We're going to take trades in certain times of the day, not all the time, certain times of the day. So I need to separate the days first, then I will use another lines to separate the times that I want, the time windows that I want. There are some indicators that you can use, but I want to show you something. I know now the open, I know the high, I know the low of the day, but we are going to take these things, we're going to do these things before even this days happen, before they get started even. You're going to use the New York time zone. The New York time zone is what you're going to use, so that you can understand the time frames, the time windows that I want you to use. So we're going to mark the 7. We're going to mark 7:30. We're going to mark, the market open at midnight open. Midnight New York open is the price we're going to mark, which is when time is 000, and then you're going to mark when price is 12 noon in New York. I'm going to use the blue color so that I can separate these to the time zones from the days. Now I have the range that I want to trade. So rule number 1 is we are going to mark the low. Before we mark that one, we're going to mark the open. Rule number 1 is you're going to mark the open of the day after noon, after midnight New York open is one of the things that you have to put a line and see. Then we are going to measure 7:30. So now I'm using the 1 hour chart, so it's going to be 7. So I put another horizontal line at 7 also. So now I know where the 7 is. I will then mark the low before 7 and the high before 7, as you can see. Then rule number 3 is if price breaks to the upside or to the downside before reaching our blue line, which is the 6 midday of New York, then we have a trade. If price does not reach there or price moves to that side after, then that day we are not going to take a trade. So this is also another day. You see, I put a line to my noon open actually midnight open, and then the noon 12. Then I mark, you know, the low before 7 and the high before 7. That's the high before 7, and that one is the low before 7. So guys, it's simple. If you have rule-based strategy, you will avoid a lot of losing trades. This one also is a losing trade. Price reached, followed one of the rules and break to the upside before reaching 12 midday. 12 midday in New York. Before reaching 12, price reached to the upside, but never gave us a chance to trade it. We did not get any chance to trade that one, so it's another missed trade, but that one I call avoided losing trade. Then we have another day here. You just do the same thing, mark these two time frames, and in between, that is the window we want. Then you mark your high before 7, the high the price created before 7, and then you mark the low price created before 7. And if price breaks to the upside or to the downside before reaching midday New York time, you have a trade. We are not just going to enter trade blindly, but we will have something that we are going to use, some criteria that we are going to use. So this is what I call a rule-based strategy. If you want more of it, I will show you. You can have a checklist of these things. You can write them down and then follow them one by one. If one step is missed, then you are not going to take a trade. That's how professionals avoid losing trades. That's how they avoid. In this market, there will be always losing trades and winning trades. But the more you eliminate your losses, is the more you become successful. And how can you do that? By just having a rule-based strategy. Now you can see price move to the upside, break to the upside. Let me put it down. That one is the high of the day before 7. So the price break to the upside, and then this is what we call a false breakout. And ICT calls the Judas swing. So price moves to the upside, then comes back inside. So now if you get an entry, the fair value gaps, the order blocks, if you see them in there, then you take a trade and you target the open. You target the open like this. Now I'm on the 1 minute time frame. You can see if you are an aggressive trader, you have a trade. You have a trade from there. There was a fair value gap. I couldn't zoom in. I forgot that one, but there is a fair value gap there. So someone might take a trade from there. I personally don't take trades that way because I'm not an aggressive trader. But then if you go to the 5 minute, you will see a different story. 5 minute now, you see the same trade but different story. The person who is watching the 5 minute, usually I'm the one that watched the 5 minute, did not even get the chance to enter the first time. Did not get the chance to enter. But then second time, there was a fair value gap there. That fair value gap is where I should be trade always. That's my market structure shift. So that's my shift. Let me mark it again. That one is my market shift, and then above it you can see there is a fair value gap. So always what I do is I put my limit order there. If price reaches to that limit order, then I target that the open of the day, then that's a winning trade for me. But it did not happen because price never reached back to my area. So some of you might get another chance by entering that fair value gap there, and you have 1-to-1 trade if you want. So you see, basically that's what I was telling you guys.